All right. Good morning, everybody. So that was fun, huh? We had two different events yesterday. One was the threat of a government shutdown that kind of came out of the blue since we had a bipartisan agreement on the stopgap measure. And then the other was the Fed with its projections of less rate cuts next year. Now, we had a warning that they were going to dial that back. So the the bias was bearish, but the move was a little extreme. The pullback registered yesterday during FOMC was the largest drop in US markets after an FOMC in 23 years. That's a pretty big statistic right there. 23 years. Now, they're attributing the entire drop to the FOMC, not giving any of that credit to the potential government shutdown by the end of the year. But still, it's a significant move. As you would expect, we're getting a little bit of a dead cat bounce, bringing us back in the other direction after such an extreme move. This is normal. We would have gone up no matter what, whether the move was done or if we were just, you know, pulling back for the next leg lower, there would have been a lift to the upside. So we're getting that. It's where we go from here that really matters and whether or not we have some opportunities to play. There's always opportunities to play. So Japan's looking good this morning, up 1%. The UK is down 1.25. That's a wide spread between those two. Right, we're talking over 2% total from the highest to the lowest markets globally. Hong Kong is basically flat, and then the US markets and Japan with the green. Really, everything else in the world is red, trying to normalize, trying to come up. And we just got Bank of England data, right? So the markets are still getting hit with new information while they're trying to, you know, recover, I guess is a good word, after yesterday's move. So we're going to get some jobs data. Remember, the Fed had claimed victory on inflation. They had slain the beast. They were done with it. They were going to focus on the other part of their mandate, which is employment. And now they're saying, you know, that sneaky little inflation demon is back again. And now they have to split their attention between fighting inflation and jobs. So we're back to that dual mandate again, rather than one problem at a time. And we're going to get some job numbers today. Now, these aren't the big job numbers. You know, non-farm payrolls is the big one. But anything connected to jobs matters. And this 246 is important. All right. So that was the previous. The estimate is that it's going to drop. This is initial jobless claims. It's for people that are just filing for unemployment. That number is expected to go down. I think if it doesn't, we could see more weakness today, more selling. And I could have swore we had some numbers last night on the revision of GDP. There was a forecast estimate. That's what it was. Somebody had forecasted a GDP revision that was not in line with this. So At 8:30 this morning, I would be prepared for more shenanigans. Yeah, it's just short and sweet. That's the concern. You also have this Philly number here, -5 to 2.5. That's a significant difference between those two. Let's get those cleaned up a little bit. So at 10 o'clock this morning, we're also looking at some issues. I went back and was looking at times where we've had significant moves in the market, and this one kept popping up. U.S. leading economic indicators. It's a subtle one. It's kind of vague, right? You don't hear me or even really anybody else spending a lot of time on it, but it kept showing up in my numbers. So that's at 10 o'clock as well, which is fine because we've already got something to be paying attention to at 10 o'clock. And that's your two time frames really that matter today. 8:30 first, 10 o'clock second. Watch the clock. It's the same mantra that we always talk about. Watch the clock. It's not like we can't see these events coming. And we're going to get some auctions in the front end, the 4-week, the 5-year. They always project these as a low impact, no matter which one it is. And that's not always true. So keep your eye on the auctions today as well. Once we get past the 1 o'clock auction, looks like we're good into the close. We're going to get data tonight out of Japan. So, the volatility on the week isn't done yet because that's a potential flash point as well, as if we didn't have enough, right? So this isn't the first time we've had a big move, which leaves us with this sort of pattern or shape, right? This is not a surprise. We've had it before. So one of the things that you can always do is just measure the previous day from its highest point to its lowest point. And for a bear flag, that 786 works out really well. Your typical bear flag has the pole and then it has the flag itself. And if it was going to continue on as a bear flag, it would break after the flag is built and we would make a new pole again. This is instead what I like to call a failed bear flag, where you get the pole, you get the flag, it starts to expand a little too far, and then it gets above that 786. If it can do that and maybe give you a Busby, then you target the half, at least the half. The thing about these really big moves is that we could run or we could get a dead cat bounce. We could mean revert, put whatever words you like there, back into the half and still continue to the downside afterwards. So just getting back to the half isn't going to be enough. We need to get all the way back up to where we came from and then continue higher from there, which is what everybody's focused on anyways, right? So we are above the 786. That's step one. We're continuing after the Busby to move towards the half. That's step two. So let's get there, digest that, and then we'll have more answers. Because if it can get above that, we've got a good chance of continuing up. And if it can't get above that, then it's really likely we come back down again. That's simple enough. The market maker move isn't going to help us because we still haven't done OPEX yet. And we're continuing to see that trading activity in the front end. So that's not going to really help us out. We are back above the put wall this morning, but we need to do it in the regular trading session. We've got the 10-week moving average that we hit yesterday on that dump, and we're back above it this morning, but we need to hold it. And you can see how resistive it was once we were underneath it and we tried to get back above it. We just kept fighting against it. But now that we're above it, it wouldn't surprise if we come back down and test it at least once. It's 59.50 basically, right? Don't worry about those 3 points, just 59.50, solid round number. And the ADRs are still really narrow, all things considered, but they are starting to expand. Remember yesterday, this was at like 78 or 79, and now we're up to 93. By Monday, it wouldn't surprise me if we're back up to 1%. We're already through the ADR half, which we're going to see on a different screen because this one's just got too much stuff. But we're back above the 10-week. We've got the 3-week overhead, 0 gamma, if we can keep the put wall. And then we got the volatility trigger way up here with the 10-day, the 20-day. Lots of things in the way for that run up. All right, the ADR. It's still really narrow, all things considered, but as I said, it's a little wider. We're already through the first red line. Even on a day like this, we still want to acknowledge previous interactions with the ADR, which suggest if we get to a red line early enough in the day, we can go to the other red line by the end of the day. That would put us down around 59.22. I know it kind of goes against the idea that we're going to recover bounce, but there it is, right? If we get to one side early enough, we can go to the other side by the end of the day. It's just statistics. There's also the threat, by the way, that even if we do get all the way back up to where we started, this is a liquidity gap. It's like getting the gap closed. So we could run all the way back up to where we started and then sell off again from there. The threat isn't over until we get past 61.50 and then, test this 61.64 and start putting in higher highs. That's when the threat would be over. Until then, we've got a lot of work to do. As you could imagine, the central pivot range for today is really wide, which implies that even if we do get a breakout, the breakout won't stick. That sentence I have heard from a few people they say it's confusing. So here's the deal. This is yesterday's range. This wide channel implies that even if we do break out of yesterday's range, that we won't stay outside of yesterday's range. Well, if you're keeping a bullish bias and this channel says that we're not going to break out of yesterday's range, or that if we do, it doesn't stick, we would have to run all the way up and break that high and break out above it and then come back in. I mean, I think we'll be lucky just to get to the midpoint, let alone get back to where we started or get above yesterday's high today. So the channel isn't hard to imagine being correct on that endeavor. The only other thing would be to the downside. If we did get some weakness and we break down, that we could perhaps come back in again. All right, well, I mean, that at least gives us a little bit of comfort to the downside that we would likely mean revert back in again if we did break down. But this channel doesn't make price do anything. It's just helping us try to understand what to expect today and that if we do break out, the breakout likely doesn't stick. And that's what we would be breaking out of is yesterday's range. We opened up underneath this channel, which is bearish. This channel is lower than yesterday. That's also bearish. Surprise. And we haven't hit that pivot point yet, which makes it an MDP. And the base case argument is that we're going to hit it, which is also not a surprise since we're almost there to begin with. Because of yesterday's move, we do have to consider where the S&R lines are. That was the wrong button. So turn the S&R lines on so we got a better idea how wide the pivots are today. Now, we've been talking about this lately as a way to kind of gauge what our expectations are. This is how wide the three levels are. S1, 2, 3, R1, 2, 3. And you can take it and put it anywhere on this chart going back for quite a while, and nothing comes close to how wide today is, which is to be expected, right? So let's just narrow it down to an S2 and an R2. Same thing. There's not one day that's even this wide within this time frame. So if we get to R1 or S1, I think that'd be about as much as we could expect. I'd be surprised if we get any more than that today. So an R1 would be 60.89 and an S1 would be 58.50. Let's just round up, right? 60.90 and 58.50. Well, this didn't provide much. And this one didn't provide much, which is to be expected because when we get an event move like this, pivot points don't matter. It'll run through anything in its path. But when we look back, kind of asking the question, what's down here that can turn us around and move us back up off of this low? It's not volume profile. It would have been something else, right? And there's a lot of things that we could have hit. That's not the issue. I'm just pointing out it wasn't the volume profile. And we really don't have anything here. If we continue the move to the downside, 5,800 does have some structure around the November 4 low, right? So around this week's low at 5822 area. That's a long ways off from, 6,000. It's another 200 points. All right, 10-day, 30-minute volume profile. This is not helpful, right? We're not going to get anything out of this. 5-day, 5-minute profile. As you can imagine, yesterday is a P shape, and we do now have a VPOC. So that gives us 2 of those to the upside. We didn't really hit a good iceberg or anything on the way down here, you know, where that turnaround point was. You'd like to think that we had dropped down into, you know, some institution's uh, pocket, and we didn't. At least we're not seeing it. A little discrepancy between the TPO and the volume profile. More trades around the 59.48, but more volume around the 59.65. So I'd look to see if we normalize a little bit here on the TPO to match the volume profile. What it's basically showing is this green area extends out farther than this blue area. Trades versus volume. Same thing with the current location. A lot more trades than volume. All right, said it the other way around. A lot more volume than trades. All right, so we've been using SPY and SPX this week for the weekly expected move because the one on the ES is broken with the new contracts, right? So at least we have a gauge on the week. This is how far we were supposed to move for the entire week. But the thing is, what we really do is we look at from the close of Friday what the range is just in one direction. There's your double, which is what the entire range would be. So we moved the entire week's expected move plus about 50% more. Pretty good move. It's very likely we're going to dead cat bounce. I mean, that's almost guaranteed. And we're starting to do it already in most of the equities that I was looking at. And the ES, the NASDAQ, the Qs, they're already doing it. The question just becomes on how far. All right, we've rallied back up off of the 10-week. Some, we were looking at it this morning. But we did come back and hit it. That's a nice reset. We just need to be mindful that we don't get below it and really start to expand to the downside. And we are 1.5% below the 10-day moving average. We've been lower than that before. If we zoom out, see examples of that. And in fact, yesterday we were more than 2.5% below the 10-day before we've started to rally back up again. Now, as jagged as it is, this really is like a wave, right? And we've ducked it down into the trough. We're looking for the rebound back up. The thing is, we don't have to make it all the way back to the 10. We can just start to rise up and then fall back down again. And we are going to look at equities, but it's worth having this talk for a minute. So there's bear markets like we had back in 2022, right? We got into the new year in January and we sold off. And through the year into November, we were down 27.5% from the top to the bottom. Different textbooks lay this out differently, but a 20% move off of the high is like your textbook bear market rubber stamp, 20% off the high. A lot of analysts don't wait for 20%. They'll call it at like 15, 18. And then, you know, you have the why we're pulled back that far to fit in with it. And then there's yields and rates and the curve and all the other stuff. But a typical regular pullback, and this was a part of the recovery pullback. So that was a deep 10% move, but That's not what we're looking for. Your normal regular pullback in the S&P for a good reset. You guys have probably heard me talk about this before if you've been here for a few years. So that 5 to 7% number. If you think back over the last 6 weeks with this runaway market and you had already closed your swing longs and you were trying to find new swing longs, you were probably frustrated because everything was up into nosebleed levels and it seemed like you were just going to have to buy the highs if you wanted to get back into anything. We needed a good pullback. Those 5 to 7% pullbacks are the way to play the whole quote buy low, sell high by catching that pullback. Since the bear market that we came out of, we've had a 6.5, a 9.5, and then a 4, and then a 3, and now we're getting this. It's just a pullback at this point. We're not looking for a bear market. We don't have that kind of reasoning behind it. We don't even have that kind of backdrop. It's a frustrated market that's throwing a bit of a temper tantrum, and they're pricing in a surprise out of the blue government shutdown on top of the Fed dialing back how many rate cuts they were going to get. Staying higher for longer, basically, is going to come back into the news again. But it wasn't a surprise. They were hitting it up in the news before Powell had FOMC anyways. It was in the papers Monday and Tuesday. So just keep the pullback in mind, 5 to 7%, and it can go as deep as 10. But if it goes past 10, then you start getting into technical analysts and their bear market qualifications. And I don't think it's going to get worse than that. But not going lower than 10% doesn't mean that we're going to rally back either. Spend some time in the charts, say back here, where we had set a high and we pulled back, pretty darn good down into Christmas and then rallied back out. But it took months where we were just in this zone. We peaked out a little bit, but otherwise that was our world for a while. We didn't have to go higher into new lands. We were just chopping in the lands that we already had. So sure, count it back 5-8% pullback. And then just remember you get that 6,100 up there, and we could stay in this pullback state for months. That's what's on the table. We're not looking at a bear market and a massive sell-off, 10%, 12%, 20%. It's not even on the table. So what do we got this morning? VIX is down 25% because it had spiked up significantly yesterday. Construction down, but it's still up 5% on a 5-day period, or it was up 5%. It's still up 3%. Bonds are down, and China's down. Everything else is up to some degree because they're bouncing after that significant sell-off. So the only ones that need to continue to go to the upside to kind of hit our benchmark would be oil and gas, biotech, uranium. Even precious metals is almost there, which is good enough. I'd count it. We got GDX up here, so we got gold miners, precious metals. We just don't have the XME yet. Close. Got chips, China, everything else moving in the right direction. As expected, right? It was supposed to bounce. So I'd been more concerned if we didn't. So everything that you look at today, you want to draw that fib on it, right? You want to draw, well, call it a quadrant line because a lot of people just get all freaked out when they think about using fibs. Don't treat it like a fib, just treat it like a quadrant line. Quadrants are going to use 1, half, and 0. Simple enough. Mark the top, mark the bottom, focus on the midpoint. You get things like Bitcoin, it's bouncing, it's up this morning 1.9%. It's got to get through that half. If it can't do that, it's going to reject there, fade back down to the bottom. Everything that you look at today that sold off yesterday is going to have this setup, and that's more than 85% of the market at this point. So what happens when 85% of the market hits this half back? That's the concern, right? There's a market concept that talks about correlation and correlation coefficients. I know, big words early in the morning. It's the idea that everything is doing the same thing all at once. We've been kind of bifurcated with everything doing its own thing, right? And this dichotomy between chips and software, one up, one down. I even heard somebody talk yesterday about Tesla, like, oh, Tesla's down, NVIDIA's up. Of course, NVIDIA's up because Tesla's down. A or B, yes or no, up or down. But then everything got on the same page yesterday and dumped. Correlation coefficient, everything, all of it doing the same thing. That's when stuff gets really scary. And it's when it has the potential for a lot of violence. We didn't have the Spot Gamma's founder's note before I started this morning, but if you read the PM one, it talked about the likelihood of us being in a negative gamma environment where we wouldn't have the market makers protecting the breakouts, right? So let's kind of think about it from this point of view. On a typical regular day, if we try to break out or break down, you have the market makers to deal with. So we try to break out and they're selling into that. We try to break down through the Globex range and they're buying into that. And it helps keep us kind of stable without traveling too far. Big breakouts don't just run all the way to the moon because they're up here selling into it and it stops it from just running away. That's the way it works in a positive gamma environment. The way it works in a negative gamma environment is that they sell into the selling. And now that we're moving up, they'll buy into the buying. So we're in a momentum market intraday rather than what did they call it? I'm going to get their note here. And this is in the PM edition if you want to go and read it. Yeah, I'm moving through it too fast. There it is. So that would be the idea, right? That we're in a momentum market now and that we can run a long ways because you won't have the market makers selling at the highs and or buying at the lows, turning price around and keeping it normalized and stabilized. They'll push the move so that if we do sell back off, they're going to sell into it. And if we do rally, they're going to buy into it. All right. That's the takeaway. Watch the clock, watch the news, be careful. I'll see y'all tomorrow.